Welcome back. Stocks moving higher today. An S&P record looks to be within reach. Nuveen's head of equities and fixed income, Saira Malik, is out with her second half playbook and joins me now. Saira, it's good to see you.
Good to see you.
So, for as much as has happened in the first half of this year, it's been dramatic. Some of these violent market moves, point to point, the S&P 500 and the total bond market index are really close to where we started the year, within a few percent. So what should an investor be considering doing, if anything, looking into the second half?
Well, I think what the first half proved is that it's tough to time the market. So my first message would be careful about that. There's three reasons the markets have continued to move significantly higher. And that's, first of all, the Middle East, where tensions have been reducing rather than escalating. Also, the Fed is the second reason. People are anticipating that first Fed rate cut coming for the year. We expect 2 rate cuts this year. And then the economy, it is slowing, but the recession is not imminent. So it is looking like that soft landing for the economy, and add to that a couple of rate cuts in the second half of this year. And that's why markets are approaching highs for 2025.
Yeah, I suppose there's no doubt that having things calm down in the Middle East is a net positive. But I find it interesting when we talk about the relief from a bad thing that didn't happen, when if you go back 4 months to February when the S&P 500 was first at this level, it wasn't as if we felt it was being held back by the possibility of a conflict with Iran, right? So I just wonder, back to those valuations and back to those levels, whether we can sort of be confident that the fundamentals are going to be able to carry it higher still from here.
Well, the concern, of course, which was the concern at the beginning of this year, is that the S&P 500 is trading at a premium again. So that is an issue. But earnings growth has been very strong, and that is what would take the market higher. Going back to first quarter earnings, expectations were for 6% earnings growth. We came in at about 12% earnings growth. So earnings can continue to move this market higher. The issue, and what brought the S&P 500 down, now that we can all look in the rearview mirror, was, of course, the level of tariffs around Liberation Day. We have yet to see any impact from tariffs, but if you assume about a 10% tariff rate for the rest of the world except for China, that hurts GDP by about 1.5%. That just gets us to skirting a recession. We don't end up in a recession with that level of tariffs. So that is, again, back to that soft landing type of scenario where the economy kind of ekes its way out of it. The Fed has the ability to cut rates a couple of times because employment markets are slowing, and they look at inflation due to tariffs as a one-time bump.
I suppose the other big feature of this year so far in markets has been, this comeback of non-U.S. equity markets, and obviously it's big rotation. Things like European defense and the rest of the world, as the dollar has weakened, have performed pretty well. Does that tell you that investors ought to revisit their diversification and either sell into it or ramp up the exposure?
I think it's important for investors to remain globally diversified. We are in the camp that the dollar will be neutral to weaker going forward, which is good for non-U.S. equities. And we are seeing other countries around the world reduce interest rates. So there is this global reduction in interest rates happening. But we are very bullish on the U.S., driven by artificial intelligence. Looking at earnings growth within the U.S., almost 2/3 is driven by technology stocks. The AI boom is alive and well. We heard that in first quarter earnings. Demand is very strong. Spending continues. And with the S&P 500 having over 30% of its market cap driven by mega cap, as long as tech and AI is doing well, that's bullish for U.S. markets. So I see the rest of the world having somewhat of a catch up to the U.S., but I still think the U.S. is going to be a strong place to generate returns.
Yeah, at times in the last several months, the bond market has seemed as if it was very sensitive to the level of deficits and maybe the outlook for continued heavy federal deficits. We have this budget bill. It's supposed to be taking shape very soon. And yet the bond market has kind of calmed down. 10-year yield is pretty much right where it's been for 2 years or so, around 4.25. So are there risks to the outlook for fixed income, or do you feel as if they can kind of act as ballast in a portfolio?
Well, the bond market has definitely settled since where we were at Liberation Day, where the bond markets and treasuries were worried, will the U.S. remain a safe haven for investors? Treasury yields were increasing. The big, beautiful bill also looked like it would add a few trillion to the deficit, which was negative for the bond market. I think any of those factors coming back into play would be negative for the bond market. An area that we like is where fundamentals are very strong, and that's municipal bonds. What we like about that segment is the yields and returns right now for muni bonds are very high relative to history, and fundamentals are strong because of the strength of the U.S. economy. States' rainy day funds, state savings rates are very high.